Hello. How's everyone doing today? What's going on, everyone? How's everyone doing today? Let's get down to business here. Let's see what we can do here. All right. Okay, so I was watching myself here. All right, so let's go ahead and let's get situated. So how's everyone doing? Hope everyone's doing well. I'm going to raise up the table a little bit. It's going to look a little weird. The microphone's here, right? So okay, yeah, so let's go ahead. We have lots of comments here. Welcome. So right now it's 2:56. I know I said 2:45. My apologies. So earnings start in about 4 minutes. I'm going to have them talk, of course, and I'm going to give my insights. A couple things that I'm looking for right now is I want them to talk about the non-insurance revenue because that's the elephant in the room, or like the sore thumb. I want to also for them to talk about the obviously the MCR of that, right? The non-insurance. And also, how is this going to perpetuate and go further when the stars get downgraded from 3.5 to 3 in association with the already over 100% MCR, from my understanding? Not over. I was looking at a bunch of Q2 data, so I have to relook at it here. Let's see here. The MCR, 104. Yeah, it's like a sore thumb, right? So we'll go ahead and have them talk about that. Then what I'm going to do something differently. I'm going to do an intrinsic value calculation on just the insurance side and not the non-insurance side, assuming let's just remove the non-insurance side, right? Because it decreased it by 70%. Okay. So, all right. So let's do that. And also just before we start here, just a quick shout out. If you guys go to Stock Terminal, so we just bought this domain. Quick shout out. We got this domain here. It's called Stock Terminal GPT.com. That's ours now. So if you go to stockterminalgpt.com, you'll be able to see our platform. It's a subsidiary under All Stock Trades. Really excited about that. All right. So let's go ahead and remove the screen here and just stop the camera. And then just in case, because the internet, I want to make sure, because I am traveling right now, so I wanted to make sure we are good to go here. I'm not in my studio. We're going to click for the webcast here. Okay. Other register. Okay. All right. So I guess now we wait. So really quick here. Let's see here. It's loading right now. They haven't started, so I'll let you know as soon as they start. Okay. Okay. Let's go over this real quick here. See what's going on. By the way, I'm going through this real time, so I'll talk to you if I see something that's worth mentioning. So yeah, revenue obviously went up, but it's funny how their members went down. So they're extracting more out of their members, given that they shed some of their members off, which is right here. We'll go over all this, by the way. We'll make a couple videos to help break this down. Let me look at lives. There it is, lives under management here. Interestingly, the insurance members, they actually decreased, right? But yeah, they're making more revenue out of them. So that's good. That's really good to see, right? You don't want to go the other way. So that's what they're trying to basically show here. And gross profit's gone up for that. Yeah, interesting. They're talking about the MCR here, but again, this is just a bad quarter for Clover. What I'm going to do is we're going to do a bigger quantitative analysis regarding all Q3s of the history of Clover Health, and that'll give us an insight on what's going on with their to see if we're seeing a favorable trend indeed. So here's the insurance side, which is what we like to see. They're pretty good there. Again, no, there's like an 85% loss. I'm gonna have to revisit that and see if they go under that. Maybe that's why they have the non-insurance side. Maybe. Okay. Revenue's gone down. We already know about this. MCR 99. They're pretty much at break even. Which there's nothing really that we didn't know about. We heard about here. This is kind of like a just checkup quarter. I don't see anything significant to um, be excited about. I'm not happy, nor I'm not like upset. I'm just eh, pretty much, right? It's just eh. So I agree with what you're saying here. Reduction in people is not good, but the most likely they shed the people that are not using the Clover Assistant effectively, and by doing so, they were able to remove those folks, and their MCR significantly improved. I do agree with you with that statement. So they're going to have to be better at figuring out how to expand. That's a really good MCR. That's a wonderful MCR. Absolutely. Also, really quickly, SoFi. So SoFi had some earnings a couple days ago, and it's crashed after earnings. So if you see Clover crash, I honestly, all right, here it is. Here it is. Hold on.
*1 on your telephone keypad.
Please let me know if you hear that.
As a reminder,
Please let me know if you hear it, ladies and gentlemen.
I'll now like to turn the call over to Ryan Schmidt, Investor Relations.
Turn off
for
my
Clover Health.
camera so you can.
Please go ahead, sir.
Please let me know if you hear it.
Good afternoon, everyone. Joining me on our call today to discuss the company's third quarter results are Andrew Toy, Clover Health's Chief Executive Officer, and Scott Leffler, the company's Chief Financial
Wonderful.
Officer.
All right. I'm going to turn
You
off
can
my
find
mic.
today's press release in the accompanying supplemental slides in the Investor Events and Presentation section of our website at investors.cloverhealth.com. This webcast is being recorded, and a replay will be available in the Investor Relations section of the Clover Health website. I'd also like to caution you that we may make forward-looking statements during today's call that are subject to risks and uncertainties, including expectations about future performance. Factors that may cause actual results to differ materially from expectations are detailed in our SEC filings, including in the Risk Factors section of our most recent annual report on Form 10-K and other SEC filings. Information about non-GAAP financial measures referenced, including a reconciliation of those measures to GAAP measures, can be found in the earnings materials available on our website. With that, I'll now turn the call over to Andrew.
Thank you, Ryan, and thanks everyone for joining us. Our results that we've reported today continue to highlight our progress towards sustained profitability and the great value derived from Clover Assistant. We've built upon our impressive first half of the year, with our insurance segment once again delivering excellent results, driving strong overall company performance during the third quarter. Our results represent another proof point in our strategic shift to prioritize profitability this year, which in turn has led us to once again improve upon our full year 2023 guidance ranges. We believe that our Q3 results, coupled with our first half momentum, further show our potential to achieve profitability next year on an adjusted EBITDA basis and without needing to raise additional capital. Before I dive in more into our Q3 results, I hope that everyone was able to tune into our Clover Assistant showcase last month, where we highlighted our cloud-based AI-powered platform and gave real-world examples of the impact we've seen through the use of Clover Assistant. I'll touch more on this later in the call, but I encourage everyone to check out the replay of our event on our Investor Relations website if they haven't done so already. Beginning first with our insurance results, we reported segment revenue of $301 million during the third quarter, representing an increase of 12% year over year. This segment continued its strong margin trajectory, delivering an MCR of 78.5%, a great improvement as compared to Q3 of 2022. I'm proud that our efforts this year to optimize our MA plan operations, grow revenue, and blunt MedX growth continue to shine through in our results. We're constantly looking to optimize our capabilities, and I expect our MA plan improvements to only accelerate into next year. We believe the performance of our insurance segment further highlights how our technology and increasingly mature operations can truly support better care management within any MA population. As compared to other similar MA plans, our membership is more ethnically diverse and has a much higher percentage of members considered low income. Studies have shown that both low income and more diverse populations generally have a higher disease burden and also have difficulty accessing needed care. We believe that our ability to comprehensively support this population while delivering strong, sustainable economics demonstrates the power of our technology-centric model. Now let's move on to the recent publication of STAR's performance for the measurement year 2022 cycle. While we received stronger scores in many areas on our STAR rating, we received an overall 3-star rating for measurement year 2022, which dictates reimbursement for payment year 2025. This result is obviously disappointing to us, but we do see this cycle as an outlier. We came very close to 3.5 stars for measurement year 2022, even with the significant increase in cut points. And the significant number of stars improvement efforts we deployed for measurement year 2023, plus the increased predictability given to us through the new CMS stars guardrails, gives us optimism about our ability to regain our 3.5-star rating in the near future. As an overall summary on stars, we are disappointed in the 3-star rating, but see it as likely a one-year event for 2025. For that year, we're committed to having strong financial momentum to mitigate its effects, and we do not see it as a barrier to long-term sustained profitability. And we anticipate our star performance improving in future measurement years. Shifting over to growth, similar to 2023, we intend to measure ourselves in terms of increasing top-line insurance revenue, and we are targeting high single to low double-digit insurance segment revenue growth in 2024. Expect us to continue to index on profitable growth through a combination of new member lives, churn reduction, and per-member revenue initiatives. As our business continues to mature, we believe that this balanced approach is the right one to help us achieve our broader goal of reaching sustained profitability on an adjusted EBITDA basis next year. We'll obviously have more to talk about regarding our annual enrollment performance at our next earnings. For our non-insurance segment, we reported a third quarter MCR of 104.1% on revenue of $176 million, bringing the year-to-date performance to an MCR of 99.7%. Even though we are continuing to target a non-insurance MCR below 100% for 2023, we continue to see challenges in the design of the program, and therefore are committed to right-sizing our exposure to value-based original Medicare. Consistent with that approach, we again expect a reduction in the number of participating physicians next year as we continue to evaluate this segment's performance. For the future of this segment, we very much believe in our ability to use Clover Assistant to help physicians go to value-based care for non-Clover MA plan patients with Medicare. We started this with ACO REACH and Original Medicare, but in the last couple of years, we have seen clear evidence that we have great strength in Medicare Advantage total risk management. As such, while we will likely continue to closely manage our exposure to Original Medicare, you will see us increase investment in Medicare Advantage within our non-insurance segment. That is, we will look to enable physicians to use Clover Assistant across their entire MA panel for all MA plans and to be able to go to value-based risk on those lives. We're incredibly excited by this adjustment to the non-insurance strategy, and we look forward to talking about it more. With that, I'll now hand it to Scott for the more detailed financial update.
Thanks, Andrew.
I'll first cover the third quarter financial highlights and then review our improved outlook for full year 2023. Adjusted EBITDA significantly improved from a loss of $56 million in Q3 of last year to an adjusted EBITDA loss of $5 million in Q3 of this year, driven by strong insurance performance and a continued reduction in adjusted SG&A relative to the prior year period. For our insurance segment, MCR improved to 78.5% in Q3 from 86.3% in Q3 of last year, building on the strong momentum we delivered in the first half of this year. Our strong MCR performance was driven by revenue growth of 12% in Q3 to $301 million and 15% growth year to date to $933 million. As we've mentioned in the past, we have continued to see favorable impacts from various operating initiatives all year, and these initiatives resulted in modest amounts of PPD from earlier in 2023 impacting Q3. Our year-to-date MCR of 80.8% contains only minimal PPD and is a good representation of our underlying performance. During Q3, we experienced a similar medical cost trend to last quarter, with PMPM Medex down 1% sequentially versus Q2, showing how our general medical expense trend is holding steady. We're always focused on initiatives to manage Medex through increasing impact from Clover Assistant, improvements to MA plan operations, including optimization of plan product design, network, payment integrity capabilities, and expansion of our clinical initiatives. More specifically, our home care program continues to be a key lever contributing to the performance of the MA plan, where we're focused on delivering in-home primary care powered by CA to our highest need members to reduce costly hospitalization and post-acute care utilization. We're increasingly enrolling higher risk new members into this program and are seeing lower inpatient admissions for participating members. We also benefited from being paid on 3.5 stars this year for our PPO plan, similar to earlier quarters this year. Our non-insurance segment revenue declined 70% versus the prior year period to $176 million, primarily driven by the smaller group of participant providers at the start of this year. Our non-insurance MCR in the third quarter was 104.1%, with a year-to-date MCR of 99.7%. This performance was relatively flat versus 104.2% for the third quarter of 2022. The deterioration from performance earlier in 2023 was largely driven by more conservative assumptions relating to benchmark used in determining performance under the program. To reiterate Andrew's earlier comments, we intend to improve the segment's performance with further reductions in our ACO REACH participation in 2024. We believe this should reduce total participating physicians by approximately 40% beginning in 2024. I also wanted to provide an update regarding settlement on our 2022 performance for the non-insurance segment. As a reminder, there is a significant lag between the time we book profits or losses under the program versus when that performance is settled in cash with CMS. We've received the final settlement report from CMS for the 2022 performance year and expect to settle it during Q4. We currently estimate the total settlement amount owed to CMS as being approximately $147 million, $52 million of which accounts for our shared loss. The remainder of the settlement relates to repayment of working capital obligations. Third quarter adjusted SG&A improved to $68 million, a 6% reduction year over year from $73 million in Q3 of 2022. We continued to see a favorable impact this quarter from some of the cost savings initiatives reported earlier this year. The UST Health Proof transition is actively underway for many of our MA plan operations, with most of the benefits still yet to be realized starting in 2024. That said, many of the mission-critical work streams are already configured into the UST ecosystem. This includes operations related to claims, new member enrollment, welcome kits, call center, and administrative functions, to name a few. And we believe this sets us up for a successful changeover in 2024. We remain excited to take advantage of the economies of scale and operational efficiencies that we expect our partnership with UST Health Proof will capture, and still expect to realize the full savings originally contemplated from the initiative. Turning to the balance sheet, we finished the third quarter with restricted and unrestricted cash equivalents, and investments totaling $672 million on a consolidated basis, with $308 million at the parent entity and unregulated subsidiary level. Our strong Q3 performance is another important step in the right direction to achieve sustainable profitability. I'm proud of the continued step change improvement in our insurance business this quarter, driving favorable adjusted EBITDA performance and giving us confidence that our results this year are sustainable. We believe that this positions us well to achieve profitability in 2024 for the full year on an adjusted EBITDA basis. I believe that we're progressing well on our mission to improve our financial performance so that we do not need any additional capital. Finally, I'll provide an update to our full year 2023 guidance. This guidance is reflective of a certain amount of conservatism in Q4 in consideration of typical seasonality risk in Q4. We are narrowing our revenue guidance for the insurance line of business to between $1.21 billion and $1.23 billion. We are improving insurance MCR guidance to a range of 81% to 82%. We are maintaining our previous non-insurance revenue guidance at a range of $750 million to $800 million and MCR of 98% to 100%. We are also improving our adjusted SG&A to between $310 million and $315 million. These changes result in an improved adjusted EBITDA guidance of between negative $55 million and negative $80 million. In conclusion, we delivered another durable proof point this quarter on our path to profitability with significantly improved adjusted EBITDA, continued momentum in our insurance results with strong insurance segment MCR, and a further reduction in adjusted SG&A from our previous initiatives. I believe that our great execution this year, coupled with our updated expectations for the full year, should set us up well to achieve profitability goals in 2024. Our aim is to continue this momentum and accelerate growth for our business on the other side of sustained profitability. Now let me turn the call back to Andrew for some closing comments.
Thanks, Scott. As always, I'll close with some commentary on Clover Assistant. From our own MA plan to the future of the non-insurance segment, what gives us great confidence in our strategy is that Clover Assistant is continually demonstrating that arming physicians with the right data helps them make the right decisions. And when they do that, the patient gets better outcomes and Medicare Advantage plans get better medical economics. We continue to derive great value from our technology with over 1,000 basis points of MCR improvement for returning members whose PCPs use Clover Assistant as compared to those who do not. Last month, we published an in-depth analysis further highlighting CA's clinical efficacy, showing how clinicians using our technology are diagnosing and managing diabetes earlier, resulting in improved patient outcomes. Diabetes is a very common disease in the Medicare population that unfortunately can result in many severe complications. That's why diabetes care has been an important focus of Clover Assistant from its inception. And in our diabetes research paper, we outlined how the use of CA is associated with earlier diagnosis, earlier treatment, a reduction in hyperglycemia and hypoglycemia, plus reduced treatment with insulin. During our recent Clover Assistant showcase, we put on display the incredible impact and efficacy we see from our platform. We demonstrated how we're leveraging new advancements in AI and machine learning so that clinicians have the information they need to better care for their patients, and how we're increasing accessibility to the platform through deep EHR integration. Most importantly, we shared in-depth analysis of how Clover Assistant is associated with earlier identification and management of chronic conditions to illustrate how we're improving patient care coordination through timely clinical insights. Lastly, and what's even more exciting than our current results, is the untapped potential of our platform going forward. We've shared in the past that we currently have over 100 machine learning models in active use alongside dozens of active or patent-pending technologies and algorithms. We're constantly launching and testing new features as Clover Assistant is always learning and always improving. Our conviction in our technology is such that we have based our entire model upon it, and we believe we are the only managed care organization whose entire focus is on managing Medicare risk through AI-powered, physician-focused software. We've made plenty of comments today demonstrating the strength of the Clover model and our exciting progress on our push towards sustained profitability. I'm proud of all we've been able to accomplish 3 quarters into the year, and while we have 1 more quarter to go, I applaud the entire Clover team for the great momentum we've generated so far this year. With that, let's move on to Q&A.
We will be taking questions first from Clover Research Analysts. At this time, if you wish to ask a question, please press star 1 on your telephone keypad. You may remove yourself from the queue by pressing star 2. In the interest of time, we ask that you please limit yourself to 1 question and 1 quick follow-up. Our first question comes from Jason Cassorla, Citi.
Great, thanks, and good afternoon. I just a quick clarification on the CMS settlement. You said you have $157 million that's due in the fourth quarter. Just making sure I heard that right. And then it sounds like you noted you wouldn't need to raise additional capital, but just given the implied fourth quarter EBITDA losses within guidance, the settlement dollars, can you just maybe help us or help bridge your cash position over the next few quarters? Would be helpful. Thanks.
Yeah, this is Scott. I'll take that question. So yeah, you heard that right. The settlement that we're anticipating in Q4 is a total of $147 million. A little over $50 million of that relates to our shared loss under the program, and then the remainder is just related to the working capital dynamics under the program, where in connection with the settlement, you pay back a certain amount of working capital that was advanced during the program. But in terms of a cash flow bridge, yes, I'll just kind of reiterate our expectation that we have no need for operating capital, certainly at least for 2023. And as I think we indicated, our objective is to reach profitability and cash flow positivity without needing any incremental capital in 2024 and future years. As far as a cash flow bridge, I mentioned we finished the quarter with $308 million of cash and cash equivalents and investments at the parent entity and unregulated subs level. And so that settlement amount that's due to CMS would come out from that. And then to the extent that we do continue to deliver any EBITDA losses in Q4 going forward, it would come out of that amount as well. Although obviously we continue to look for opportunities to leverage the capital that we have remaining at the regulated entity level, and that's kind of an organic flow that occurs over time. But in general, we are comfortable with our capital position now, and again, look to a strong 2024 to insulate ourselves from requiring any further capital.
Okay, got it. Thanks. Helpful. And then maybe just a follow-up. I wanted to ask about utilization trends in the quarter. Obviously a strong result with the 78.5% MA MLR, but it looked like medical cost per member per month grew about 11% year over year. I know you're more than covering that with a 22% revenue PMPM, but just curious on what you saw on the utilization front, if there's any caveats that are driving that year-over-year medical cost per member per month trend versus kind of the 2 to 3% you were doing in the first and second quarter. Be helpful. Thanks.
Yeah, so I'll comment on that. First, at a high level, I'll tell you from a utilization standpoint, we're not seeing anything very different from what we had seen earlier in the year. And as a reminder, when we reported Q1 and Q2, we indicated that we were seeing fairly benign trends from a utilization standpoint. The year-over-year increase in PMPM medics that you're referencing is distorted a little bit by something that happened last year where we had some favorable PPD impacting our medics in Q3 of last year, which distorts the comp a little bit. I think what's more representative, and we tried to anchor people last quarter and this quarter now, instead of any one quarter, looking at our year-to-date performance as being more representative of the overall performance this year, especially compared to last year. And so as we said in our prepared comments, we're running at about an 81% MCR on a year-to-date basis. And when you look at the year-to-date PMPMs, medics is only up about 5%, which is more representative of the benign utilization trend that I referenced.
Our next question comes from John Penny, Canaccord Genuity.
Hi, John Penny on for Richard Close. Thanks for the question. Just want to talk about the applied adjusted EBITDA ramp in fourth quarter. Can you just possibly flesh that out on what exactly you're expecting? I assume some increased utilization, but any additional color would be great. Thanks.
Yeah, so earlier this year when we made updates to our guidance, we got similar questions around what was implied about the second half of the year. And the way we've been answering all year is that we continue to model our guidance with what we think is appropriate conservatism in the remaining part of the year. Q4 in particular, just due to seasonality risk, often Q4 is one where you see elevated utilization level historically due to flu season, or more recently, of course, due to the risk of COVID, any kind of increased COVID-related utilization. And so the conservatism in that number is really driven by that exposure, but there's nothing specific that we're pointing towards.
Okay, great. And then one follow-up. I guess we're pretty early in the annual enrollment period, but is there any commentary you can give on how that's proceeding, or perhaps like what retention is looking like, or any color you can give would be great there. Thanks.
Yeah, this is Andrew. So we're not giving any guidance right now on the AEP. What we'll do is we'll obviously discuss it in a more fulsome way at the next earnings. But what I will do is reiterate that just like this year, we are looking to maintain growth in our insurance revenue. We discussed that during the remarks, and that will come from a combination of membership growth during the AEP, growth during the year of membership, reduction in churn, and per member revenue initiatives. So we are very focused on growing that insurance revenue in that single digit to low double digit range, as well as maintaining highly profitable growth. And that's where our attention is focused.
Just a reminder, to ask a question, please press star one now. And that is star one. Our next question comes from Jason Cassorla, Citi.
Great, thanks for letting me back in the queue. I just wanted to go, Andrew, back to your commentary around reducing exposure in the non-insurance business. Maybe can you just give us a more color on the decision, to reduce for the second time in 2 years? I think last year, you shifted towards working with higher performing physicians to help offset on the profitability front, but it sounds like even in that context, you're still looking to get smaller there. I guess just any more color around that decision. And then can you remind us, that business has a relatively small SG&A load, correct? As you think about reducing membership there.
Yeah, so a couple of different points there. Thanks, Jason. Number one, I would just make sure that we're clear in our remarks. The non-insurance segment, which is where we do not play a role as an insurer, remains interesting to us. The remarks that we made earlier today are specifically to do with the original Medicare, the ACO REACH component of the non-insurance business. And so what I discussed was the fact that the original Medicare area, we continue to reduce our exposure over there and to look to that we right-size that business. While we are very excited about the possibility and our capability of increasing our exposure on the Medicare Advantage side, but also within the non-insurance segment, right? So that means we're not an insurer, but we are helping providers manage Medicare Advantage risk. I just want to make sure that I clarify that particular point. Your last question, yes, we said before that it's a relatively smaller part of our SG&A load, which makes sense because of the nature of that particular program. And the last thing that I'll say there is that I think that what we're looking for in terms of partnerships and in terms of applying Clover Assistant is places where we can help providers move their entire book of Medicare risk, Medicare book towards risk, including MA. And that's part of our right sizing of this program, is introducing that MA side of the program versus looking at just original Medicare. So as we look at the future of the non-insurance segment, that's where you should expect us to go.
Okay, got it. Thanks. Very, very helpful. Maybe just one last follow-up here, just on that MA side, in terms of offering the non-insurance for the MA side of the fence. Can you remind us, do you have any lives there now? Would that be kind of a new jump in at this point? I'm just trying to get a sense of where you're at there now. I thought that generally most of your membership in the non-insurance business is almost entirely ACA or ACO REACH, but just any color or clarity of where you're at there now. Thanks.
Yeah, really fair question. So in terms of whether we have any of that right now, what we haven't actually shared the sizing of that particular program, and the majority of it is in that original Medicare program, that's for sure. But we definitely see opportunities there. We've been approached, we've had discussions, and so while we haven't shared exactly where we are with that program, and we're sharing today that we're very excited about where we can go with that, we haven't actually given any of the numbers in terms of like how many lives we have there.
Okay, thank you.
Again, to ask a question, please press star one now. Again, that is star one to ask a question. This concludes the Q&A portion of today's conference. I would now like to turn the call back over to Andrew Toy for any additional and closing remarks.
Great. Thanks, everyone, for all of your questions. So I hope that our third quarter and year-to-date results really give everyone another durable proof point, highlighting our ability to drive great results this year. And thank you all again for joining us on this exciting journey.
This concludes today's Clover Health third quarter 2023 earnings call and webcast. You may disconnect your line at this time. Have a wonderful day.
All right. Let's go ahead and share the screen. Okay. All right. So let's go ahead and do that. All right. Let's go ahead and all right, guys. So let's go ahead and do some analysis. So first things first, I wanted to, really sit down and listen and focus on this. So my just a very quick response. This was probably the most shittiest earnings call that Clover Health has had in quite some time. Very, very shitty earnings call. I mean, you could see some of the comments in our YouTube live in regards to the response, especially with Bank of America. That was actually a good question. In regards to their non-insurance MCR, as I said in the beginning of the YouTube live, I said the two things I'm going to be listening to is the non-insurance MCR. And how are they going to navigate the 3.5 to 3-star rating? So we already knew about those things before coming into the call, right? So in terms of the analysis kind of mentally right now, what I'm thinking of, Andrew Toy specifically stated that he is going to downwrite and underwrite the non-insurance side for Clover Health, okay? So that's the one that's burning a lot of cash. Now, again, for folks that just don't know, haven't looked at the data here, let me just show you here, okay? So their insurance revenue is actually, doing well in terms of growing 12%. What I like to see more, of course, but that's an honest 12%, especially if they're focusing on two fronts, the insurance and non-insurance side. The insurance MCR is doing well, right? But if we were to just go really quickly to Q2, which was last quarter, which you can see here. If you go to the MCR for non-insurance side here, you can see it went from 106 down to 99. So that's really good. That is really good, right? But especially near break even. But for this one, the non-insurance MCR went from 104.2 to 104.1. It's like, okay, you improved by 0.1. That is crap, right? So I went ahead and on our stock terminal here, I went ahead and said will be doing a analysis. And I said, as of right now, non-insurance revenue, that business model in this economy needs to be destroyed because they don't seem like they are able to overcome the challenges. The challenges of profitability unless they can. They just they have to get rid of it, right? So they are going to be downsizing that. So I expect lower revenue growths for the non-insurance side. And I'm going to get to like the overall take home, kind of the summation of all these facts. Okay. This is just too high. This needs to get cut. And they told them to cut this earlier on. This needs to get cut, right? The current program needs to, they need to figure out, why, the people that offered them a 99.6% MCR, the non-insurance side, what they basically need to do is they need to look at all the folks that are giving them an MCR of like, under 99, 98, 95, and then keep those. And then all the ones that are over 100 MCR, they just need to get rid of that. Okay. So that is what's going on from that angle. Okay. So what I'm going to be doing now is I'm going to do an intrinsic value calculation on just the insurance side, not the non-insurance side, just the insurance side. I want to value the business from the insurance because that's the one that is going to essentially that's the one that's going to be profitable, right? Based off of the numbers that I'm seeing now. Okay. Now, in terms of, this term, adjusted EBITDA, I don't like, this is like, so EBITDA. Okay. So there's three definitions, right? There's net income, right? There's EBITDA, and then there's adjusted EBITDA. Net income is the gold standard. EBITDA is EBITDA is shit, and adjusted EBITDA is adjusted shit. Okay, so now what we're thinking of, and what we're doing here, is we're going to go ahead and do something different. We're going to go ahead and look at the stock terminals GPT. And I'm just curious to see, let's say at stock terminal, what is the difference between net income, EBITDA? Okay, hold on. EBITDA. Net income versus EBITDA. Adjusted. And that's our stock terminal here. So I can give you a better definition that's a little bit more sophisticated. Okay. So I just want to focus on adjusted. So adjusted EBITDA takes the concept of EBITDA further by making additional adjustments for non-recurring or extraordinary items that may distort the company's operating performance. These adjustments can be one-time expenses, reconstruction, yada, yada, yada. Okay. Now I'm going to go ahead and say, from an intelligent investor, Benjamin Graham, security analysis, intrinsic value approach, what metric should be highly weighted? Net income, or EBITDA, or adjusted EBITDA? My answer is net income. Okay. Oh wait, you want me to copy and paste the information? I can copy and paste it here. But honestly, you can sign up for the stock terminal. You can pause the video. It's too much work, dude. All right. So, when applying the intrinsic value approach, net income represents the company's bottom line. So that is, so when they talk about EBITDA, adjusted EBITDA, that doesn't get me excited. Okay. So what they're saying is they're going to be adjusted EBITDA profitable by 2024. But they said something that I like. Okay. They said something I do. There is good news. They said that they're going to become free cash flow positive by 2024. So by 2024, they are going to become free cash flow positive. And if we were to go in and open up one of our terminals here, and if we were to, let's see if we can go to Wall Street here, and if we can go to Tesla, let's see here, we can fetch the data. Typing the symbol wrong here. Oopsies. Let's see. And fetch the data here. Oh, it's not. All right, let's look at the master symbol here. Tesla. Master symbol. Okay. Maybe I put it in caps. All right, let's go ahead and download here. Okay, let's click this on. Oh, nope. Okay, now it's given it to me. Okay, good. All right, so I want you to listen to this, okay? So if I want you to look at Tesla, okay? I want you to look at free cash flow, okay? Tell me when it became positive. So here's negative, 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 negative. Oh, it became positive here. So go all the way up. It became positive in 2019. Okay. Now I want you to look at, so here's, free cash flow went positive in 2019. Then net income. I'm going to ask you, when did net income become positive? It went from negative, 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 negative. I mean, fuck, man, negative $2 billion. That's a lot, right? Negative, 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 right? What? It's positive here. So 2020. So Tesla became negative free cash flow in 2019, and it became positive net income in 2020. So it took a year for the transition of negative to positive free cash flow to turn into positive net income. So I'm expecting Clover to become net income positive anywhere between 2025 and 2026. They're going to become EBITDA positive in 2024, free cash flow positive in 2024, still net income negative, but then 2025 and 2026, that's when the net income positivity is going to come into effect. The issue here is 2025 is going to be a very tough year because their 3.5 star rating will be downgraded to 3. They said that this is an outlier, that it's going to basically bounce back. And if you were to look at the measurements per the star rating, they actually scored really good on the important things, the things that is going to make your patient live longer. Okay. So that's that perspective. Okay. Okay. So let's go ahead and we got this part. Now let's go ahead and do the intrinsic value calculation. So like I said, I'm only going to do the intrinsic value calculation for the insurance side. I'm going to leave out the non-insurance. So if we do that, I believe one of our members posted a nice little summary graph here. So their expected insurance revenue is going to be 1.23 billion. So we're going to put that here, right? We're going to put, it's really 1230, right? It's pretty much what 1.23 billion is, right? We're going to take 5%, so 0.05. We're not taking 2 billion anymore. I want to eliminate the non-insurance revenue because I think that's killing them right now. So we're going to hit that, and we're going to multiply it by 5%. You're going to get 61.5 million in estimated free cash flow. So we're going to put estimated free cash flow here, 61.5 mil. Okay. And we're going to go 10 years into the future, and we're going to discount back at anywhere between a discount rate from a recession to bull case. But then here's the catch here. We're going to go back up here. They're growing their insurance revenue at 12%. I don't know. Did they calculate it here? It said insurance grew 17% compared to Q2 2022. Yeah. So this is whole 17%. I'm not, this is bullshit. I'm not taking the 17%. What I want to do is I want to take the revenue growth specifically from quarter of last year to quarter of this year. So I'm going to take 314.4 minus 268.5. I get 45.9. 45.9 divided by the original 268.5. Wait, am I getting this wrong here? Oh, wait. It is 18%. Hold on. Let me do this on my calculator. Let me see here. 314.4 subtracted from 268.5 divided by 268.5. My apologies. I am wrong. They're going at 17%. Correct me if I'm wrong, guys. Wait, never mind. I am wrong. Look what I'm looking at. I'm looking at Q2 revenue earnings. We're in Q3, so I'm pulled up the wrong tab. That's why I'm like, this is wrong. So this is their revenue right now for this year. Now, again, if we were to average it, we're doing a quarter. I mean, this is by far. So it's 17. But the reason why my brain wasn't taking that is because it's wrong. We're in Q3. We're getting data from Q2. My apologies. So here's Q3. So Q3, they have a 12% here. Okay, good. Insurance grew 12%. I'm like, that's bullshit. What the hell is that? So insurance grew 12%. Okay, and again, I'm looking at this live with you guys, so I'm like just dissecting this with you guys. This is what I would do on my own time, and kind of I'm doing it live with you. Okay, okay, so it's 12%, right? If you take this number, it's 12%. Okay, now again, we're gonna do 17%. We're gonna do 12%. We can find the middle ground, but we can assume we can say that this is by far Clover's worst quarter for this year, at least, right? I mean, it's just not good. I mean, look, it's, it's like, okay, I'm gonna look at all the other Q3s that happened in the past, but historically, I think Q3 is one of their worst. So let's go ahead and let's just do 12%. We're gonna do 12% for the intrinsic value. Okay. Now, to make sure this is an accurate, I don't want to like garbage the shares outstanding. So I'm going to go to our stock terminal, guys, and I'm going to go to the shares float. Okay. So I'm going to type in share float here, and I'm going to type in Clover. Okay. And I want to get the exact share count, outstanding share. So 484. We'll call it 484.8. Okay. Fair? 484.8. Okay. By doing this at 12% revenue growth with an estimated free cash flow of 5% of 1.23 billion, you get a stock price of a recession level of 1.06, a bear case of 1.86, a base case of $2.42, and a bull case of $3.34. Okay, guys. So already right now, if you were to pull the stock price of Clover, okay, you were to pull the stock price of Clover. And there's going to be people who are like, no, we need the non-insurance. We need the non-insurance. Guys, right now they're trading at $1.99. We'll call it $1. Okay. The non-insurance side is the poison. It's poisoning the company right now, right? I mean, you can see it here. So the question is, how can you do a DCF for an unprofitable? So this is a little trick. It's called estimated future free cash flow. You can back test this model since 1940s, and you'll be able to come up with the same information on free cash flow negative companies. Historically, you can estimate the free cash flow of the revenue by 5%, which equates to a free cash flow. We talked about this in the past, so you can watch our past videos about that. Okay. So that's pretty much it there, right? If they remove the non-insurance side, which they said they're going to underwrite it, then we can get at the $3.34, $2.42. Now, currently it's trading at, let's see what it's trading at here. Let me go ahead and make sure we get this right. 99 cents, right? So we'll put here 99 cents. So that is a 7% increase from the recession case, 88 from the bear case, 144% from the base case, and 237% from the bull case. Now, if we were to go ahead and if we were to put the 17%, which was what Brandon calculated from Q2, let's say that is the best that they've done, right? If we were to put 17%, and this is, again, just their insurance side. I'm not looking at their non-insurance side. We get a price of $4.81, which is 386% increase. Okay. So that's from that angle. Now, assuming since their MCR is historically low, if you were to just analyze their MCR, it is just really good for the insurance business because it is like literally near the 80%. It is really good. So what I'm going to do is we're going to say, let's say we can put this, I would say at 6.5%. So 0.65, right? That'll turn estimated free cash flow to around 79.95 million, right? Okay. So by doing that, you see an average price. I would say if we were to take the best quarter and the worst quarter, 17 plus 12, you get 29. 29 divided by 2, that's around 14.5% growth rate, which is what we've been hitting around, right? We get a stock price of $5.21, which is a 426% increase. So overall, right now, if you think this is a recession case, we are undervalued by $1.58, okay, which is 59%, right? And if we were to go to, let's say, Webull here, and if we were to look at Clove, you can see that we hit that right here. The market was pre-pricing this in terms of there's a lot of resistance here. So expect a lot of resistance to happen at these levels. So this is what I was talking about, how you can use fundamental analysis and technical analysis. So these are your fundamental analyzed resistant lines. These are fundamentally resistant lines on top of your Fibonacci sequence retracements and your support and resistance that are AI driven. So what needs to happen? Well, they need to figure out how they could essentially increase their non-insurance revenue but decrease their MCR. How the hell are they going to do that? I don't know, especially when they've decreased their non-insurance revenue. They let me close off Webull. They've decreased their non-insurance revenue. And on top of that, they still they haven't improved in Q3. So at 104, I mean, that's laughable. That's laughable, right? So that's something that they need to fix. And the only answer, if Andrew Toy is a good CEO, the only answer is you need to cut the non-insurance side. That's a shitty program for them, and it's just not working out for them. So they need to take all that money that they're burning, all that attention, and focus it on the insurance business. Okay. Now let's go ahead and now let's grow the insurance business, let's say at 30%, right? 30 to 35%. If we were to do that, and I'm right now looking at it, I'm like, what is the ceiling at this growth rate? The ceiling at the historic new growth rate of Medicare Advantage programs with the particular tailwinds that are supposed to unravel in these types of companies. So I would say anywhere between 30 to 35%. So we could say 32.5%. That's a fair number, okay? And by doing that, you get a price anywhere between, obviously the recession is just out there. That's like really hitting it bad. But if it's a profitable company, I would see an 18.79, $18 stock, $18 to $19 stock, which is 1,798% increase. That's a 17x on your investment. So for me, by looking at that, I'm very excited and I'm going to take advantage of this. Now, every company has good quarters and bad quarters, right? To all the people that stuck around in Tesla and Enphase and all, this is typical. It didn't change their outlook. They have a hiccup in 2025. They're going to fix it in 2024. So I really enjoy this. I think this is going to be good. And I'll be able to double down on more, which is good. I honestly, I'm going to be doing some selling of other companies that have done really well for me, like NVIDIA and whatnot. And I'm going to be remanaging the portfolio of mine to go in and be able to get more at these prices. And I hope that this stays like this, which I think it will for the time being, hopefully in the next future 2 quarters. Okay. So then now that we essentially did this analysis for Clover, and by the way, this is from the revenue growth of just 1.23 billion, the estimated free cash flow. Okay. So there's that. Now, what do I expect from the economic forum? What's going on with the Federal Reserve? Well, here's the thing. Okay. You have to ask yourself, how was Clover trading at $28, 10, 15? How did it become public at $10? Because the market was prioritizing, growth over value. The market was prioritizing growth over, minimizing cash burn. They were okay with cash burn. Now you might argue and say, well, Al, that was because the 2020 pandemic. That was because there's a lot of the ZERP policies they had with the money. But I want to give you just one example here. If you look at Jumia stock, okay, and I want you to look at just the historic part of Jumia. It's true. The Federal Reserve started their easy monetary policy in March. They cut interest rates. And then the stock exploded past that line. It was actually $60-something. That's a 2,500% increase. And it was trading at around $2-ish, a little lower. But the question begs, how the hell were they at $40 before the pandemic, before the zero interest policy, before the retail investors went crazy? Retail investors, there really wasn't a lot of retail investors in 2019, ladies and gentlemen, right? So 2019, you can see Jumia at 40. And was it burning cash? You bet your ass it was. Of course it was burning cash. Okay? Right? If you look at Jumia, let's do the analysis here, okay? We'll open up Jumia real quick. Okay? This is part of our stock terminal here. And if you go to free cash flow, negative, let's go to 2019. Look at that. Look at that negative. Negative net income, and yet it was trading at $40. Okay, so if you do the math, it was at 262 million right now. So if you do 40 divided by 2 points, it was at technically 50, but whatever. 15, 262 times 15. It was trading at around $4 billion. Okay, a little bit more. So what I'm trying to say is, once the Federal Reserve starts cutting interest rates, and once you get in a position where the interest rates go low, money will become cheap, and venture capital will be able to finally do their job, where to underwrite a bunch of checks for that one check to essentially balloon. The question is, has the system changed? Has evaluations changed? And there are a couple of things that, there's a lot to the equation, okay? Like if you were to go to our stock terminal and go to the Nancy Pelosi tracker, okay? If we were to go to the Nancy Pelosi tracker, and I want you to zoom in here, something to keep an eye on. Politicians have been making some unusual bearish moves against the U.S. economy in the last 3 months. Tom Carper, Democrat, bought 45 million of like a hedge, which is an inverse ETF, meaning that if the economy goes, the stock market goes down, he makes money. Mr. Franklin here, Democrat, sold $940,000 of stock. Mr. Ricketts, Republican, sold 2.75 million of stock. So potentially there might be a recession in the horizon, or the news of a recession, even though we've been in one, I think, in terms of a tech recession or a rolling recession, which we've discussed in our past videos, a lot, right? So, so there's a lot of moving parts in juggles, but I'll tell you right now, once the Federal Reserve starts cutting, that's it. It'll go, that's it. It's easy as that. Okay. So, because that's just how, the Federal Reserve controls pretty much the stock market. That's pretty much how it's been since, I've been involved in it. So now let's go ahead and take a look at the comments here real quick. And let's see. Okay. I'm going to just go to the comments real quick to see. Let's see here. Okay. Yeah, so I like what Dan here is saying. So reality check, CLOV at $10 in 2027 is a 10x on your investment in less than 4 years. That's like VC level returns. Exactly. That's but again, there's a lot of people, they want to million X. I don't know, but that's pretty damn good, right? And then there's, again, like I said, there's going to be people who are going to have an argument that they're going to basically say, Al, yeah, but I bought at 10. I bought at 15. I bought at 10. Okay, well, you've had all this time, right? What the fuck have you been doing? Again, you want to buy when there's fear. There's fear right now. I mean, just look at the comments, right? Which we've analyzed here. So let me just add to Dan's analysis here. Let's go to the research edge really quickly here, and let's go to, ladies and gentlemen, whenever there's fear, it is equivalent to a buy. When the people are fearful, RSI is oversold, becomes below the intrinsic value. Conclusion: be greedy when others are fearful. So you're going to see some idiots be fearful, but it's fine. You can make money off of the idiots. Somebody said, I think I read it and I just started laughing. Somebody literally said right here, I sold everything. I think he's joking, but I sold everything. Okay, that's great. That's good. We want that. Okay. All right. Somebody made another comment here. After you become a full-time brain surgeon, how will that impact your YouTube activity? Exactly. So, Mr. Kumar, you hit it right on the knob. How will this impact my YouTube activity? So, because of this transition, there is going to be a very significant decrease in my YouTube activity, which is why I've created this platform, which you can find. It's literally stockterminalgpt.com. What? Stock Terminal GPT, like, ChatGPT, stockterminalgpt.com. And you'll have all of my insights, all the data. And this is a couple of them, walk through right now, the products that we have. And there's a lifetime access if you would like lifetime versus a monthly subscription. We have been featured on Bloomberg, Yahoo Finance, NASDAQ, and other Benzinga and everything. Here's the stock terminal. Here's the stock terminal GPT portion. You ask it questions, like one of our members asked, what's the difference between a DCF, 80s, and then it was able to break it down. It's AI enhanced analysis, ask and invest, data at your fingertips, and you can read more if you're interested. Another thing we have is called exclusive access to billionaire insights. This is Chamath Edge. Recently, Chamath published so I pay Chamath $109 a month, right? And I get access to his research. And I have other hedge funds that I pay, obviously, in the thousands every month to get access, tens of thousands, right? To get access to some data, right? And these are going to be basically billionaire moves, portfolio power-ups, and data-driven decisions. So with Chamath, He did reference in my Chamath Edge write-up his SPACs in his private write-up, and I was in information regarding what we can see in the next 2 to 3 years in the future from the Federal Reserve. And what I did is I took that information, I recurated it, and typed a summary and put it in our Chamath Edge. And if people that are interested in this, you can go to stockterminalgpt.com, which is a subsidiary under our stock trades. So to answer your question, that is my activity is going to be heavily involved in the platform that I created in the stock terminal. I'm probably going to come on not too much on the YouTube channel. It's going to be, maybe lives like this, earnings, but there's going to be some earnings where I'm just probably going to cover in the private chat, group. Again, once this hits its intrinsic value and they fix these road bumps, and I think I've done my love for the YouTube community for retail investors. If they want access and want to learn more, you'll be able to find me here. And there's testimonials. There's people here. So anywho, that's it that I have regarding that answer. Let's go ahead and let's take a look at other comments. So yes, that's true. Elon came out with his own thing called Grok. But if you look at the analysis of Grok, it is actually inferior of GPT-4. So our terminal is actually stronger than Grok. So if you were to go to Twitter, and if we were to look at the specifications of Grok, honestly, I feel like you can look at it here. Maybe they have the website. No. If you look at the specifications of Grok, the analysis of it, you can see the data here. Here's Grok, and here's GPT-4. And you can see Grok is 62.9%. GPT-4 is in the 90s, right? So it destroys Grok, right? So I think I'm comfortable with how I built the generative pre-trained transformer. So very happy with that. So there's that. So there it is. So I'm very excited, and I agree. His average is around 575, I believe so. Yeah, guys. I mean, that's pretty much it. That's I have for you guys. I hope you enjoyed the video. Please hit up with a like, subscribe, and we're gonna go ahead and continue with these insights. And I'm very excited for the stock terminal. I mean, damn, doesn't this look sexy, guys? I mean, this thing is really built. I mean, I built this from the ground up. So I'm very excited with our stock terminal GPT. And just very quickly, we do have our Black Friday sale. If you type in Black Friday in our mastering and or bundle, you'll get $1,000 off, lifetime access to everything we offer here, everything. But that's all I have for you guys. I hope you enjoyed this video. Thank you so much. This was a dud quarter. We're going to see what the outlooks are for next year. Again, just very quickly, I expect EBITDA profitability by 2024, which is a bullshit profitability. The biggest thing I want to see is free cash flow positive, which is what they said in 2024. That should tick up the stock price. And then once net income becomes positive, which I don't think is going to happen in 2025 because of that dud year that they have for the CMS 3-star rating, I think it's going to be 2026. But overall, like what Dan was saying, 4 years to 5 years and you 10x your investment. Come on, guys. Come on, right? And then we'll see what happens after that. We'll do another intrinsic value. But overall, I'm very excited for this because we have an opportunity to get in on Clover at even a lower price. So that's great. So 98 cents. So keep it coming. Drop it down lower. Very excited. And we'll go from there, ladies and gentlemen. I'll see you on the next one.